Hi everyone! So as promised, this is part 2 of the webinar on the tax reform law. Okay, today we're centering on tools or tips, or what I'd like to share with you, tools and tips on implementing the actual implementation and details on how you would update everything in your HR department when it comes to the train exemptions. Okay, so the 54-page document that was released in December last year could be a very, very overwhelming and really hard thing to digest for any HR champion. But I'd like to break down that 54-page document into 3 points. These 3 points are what you would most likely have to make sure that each of your employee knows. So in a nutshell, if you get these 3 points right with your employees in terms of the train, everything should go smoothly. Of course, a disclaimer, I'm not saying that it's gonna be the perfect solution on how to implement those changes. Okay? So let's go to point number 1. What's the first thing that you should make sure you implement as to the train changes? Now, the first point would be to make sure that everybody on your payroll team and on your HR team understands that under train, all tax statuses have been abolished. So there's no more single, there's no more married status, there's no more married with 1 dependent, married with 2 dependents, 3, 4. Now, the notion or the logic or the wisdom behind that old status or that old structure was because a married individual would naturally or presumptively have more expenses than a single employee, that married employee is given a higher tax exemption. Now, online, it's interesting to note that there's a lot of feedback from single employees out there who complain that though they are officially single, sometimes they also have to provide more versus their married counterparts. For example, when you say married, you got a husband and a wife working together to provide for the needs of a family. Vis-a-vis, if you have a single employee, that employee is the sole breadwinner, say for a family of 3, 4, 5, and the number goes up. Okay, so because he's taxed more, his net pay is decreased more versus the married employee counterparts. Okay, now under train, right, all those tax statuses have been removed, basing the income tax only now on gross annual income. Right? So regardless if you're married, single, it's complicated. All the math depends on your annual income. Now, other employees, especially those who are married, might argue that's unfair for us who are married. That's unfair for us who provide for our children. The defense, not really, or the wisdom that President Duterte's administration is explaining that regardless if you're single, married, or have mouths to feed, you earn and you spend like any individual citizen out there. So it's like equalizing the costs, equalizing all opportunities. Now, as HR champions, that point has to be very clear with all members in your team, because it's a common question that's often asked by employees. Why were all the tax statuses removed? How is that different from the old way and the new way of income tax? Okay, so my advice is always go back to that 54-page document and make sure you understand the why as to the tax statuses and the changes in the annual income computations. Right? Point 2, okay, in implementing train would be you have to make sure you understand the math behind the 82 now changed to the 90K tax exempt bonuses. Okay, this includes the 13-month pay. Okay, it's a very for my take personally, it's a positive point to communicate to employees, because a difference of 8K non-taxable net amount take home at the end of the year, or maybe in the middle of the year for some companies who split their bonuses, that's a big difference. 4K, say in June, could actually still cover academic expenses, or say a full 8K during Christmas time could still benefit a family, or something that you would want to do for those close to your heart, right? So what you need to understand though are the items, the specific items that are included in the 82 to 90K tax exempt bonuses. So when we talk about bonuses, you're not just talking about cash, that which you give to your employees through their ATM cards. You also have to understand gift certificates, okay? Any bonus that may have monetary counterparts. If you go above the 90K, the moment you go above the 90K bonus or rewards, you may, right, subject that to tax. Again, I bring you back to the 52-page document. Go through the items that are identified there as included in the 90K tax exempt. Okay? There's not much change actually when you talk about rank and file level to mid-level employees in terms of the 90K tax exempt bonuses. Perhaps the most impact would be felt for those who would say hit the mark of a 6-digit monthly salary. Of course, if you hit a 6-digit monthly salary, and simple math would show you that at the end of the year you're going to be over the 90K, right? So anything over the 90K would be subject to the taxes, right? So one good thing to also look at would be how you structure your benefits program. Are there ways of restructuring the program instead of cash or instead of monetary items? Perhaps it would be good to revisit learning and development items, service items, benefits that are not necessarily received in monetary form by your employees. Now, question would be, what have we implemented in our organization for that? At this point in the discussion, I guess I'd leave it for a different webinar, but to get into the details of the non-monetary benefits would take us again another 30 minutes. But the question of yes or no, are there possible items? Yes, there are, across different kinds of industries. If you want to find out more of that, please look out for the series that we'll be coming up with on that, or please feel free to email or chat us up, and we'll get back to you in terms of the details for those items. Okay? All right. And the third point, this point has actually raised so many questions during the IBPAP conference that I attended, where the guest speaker was no other than Undersecretary Karl Marx himself. He gave a very, very objective answer, to say the least. Nothing that put the entire community's hopes too high, but also objective in the sense to set the right expectations. So what's the final point that you have to make sure of understanding clearly when implementing the changes of strain? That third point would be the presidential veto on the preferential 15% tax for regional headquarters and offshore banking units. What does this mean in a nutshell? Historically, ROHQs and offshore banking units have enjoyed a 15% preferential income tax rate for their qualified employees. Under TRAIN, that preferential tax rate is now abolished. 0. Okay? It's no longer applied. Which means that all employees of ROHQs and offshore banking units are now subject to, wait for it, the regular taxes as implemented under trade. Okay? So, what does that mean? Okay, basically for employees. If you look at it without doing the math, if you look at it from a bird's eye view, the natural reaction would be, if I were an employee in an ROHQ, my tax is gonna skyrocket, right? This may be true, okay, if your monthly income again is under the 6-digit figure, okay? But for employees generally, again, I'm saying generally, for employees generally under rank and file and mid-level management, if you do the math, if you apply the calculations of the new tax table, you'd actually see that there's not much of a change from the 15% to the new tax table. The impact, the biggest impact of the veto on the ROHQ would actually be for senior level to director level salaries. So it would be good to actually review those salaries with your team in HR, right? If you head the HR department, I would highly advise that you go through the salaries of your senior management. I mean, senior management people are very key in running the business. I understand that totally. In order for you to have a plan, a strategic plan, review those salary grades and see who would get the most impact with the changes in ROHQ. Okay? So, to all HR champions out there, to all operations champions out there, thinking of train, whether we like it or we like it, it's implemented. There's no going around it, okay? Thinking about train in terms of income tax, remember those 3 points. Remember, you understand those 3 points like the back of your hand. I'm not an accountant. I'm not a finance person. But I knew I had to make sure that I understood those 3 points. I don't understand the entire 52-page document of train, but I think at this level, I am confident that I understand those 3 key points and the impact they have to the organization that I'm with and to the employees that I serve. So again, one would be there are no more tax statuses, okay? All income tax is based on annual gross income. 2, 82K tax exemptions from the old structure has now been increased to 90K. So consider anything above that, consider giving benefits or bonuses that are non-monetary so that they don't get subject to tax. And third, the veto on the 15% preferential tax rate for regional headquarter offices and offshore banking units. As HR champions, getting into the nitty-gritty details of these 3 points, knowing these 3 points like the back of your hand, doing your research, talking to people, getting validation from experts, that will help you become strategic as you champion and manage the changes that this will have on your organization and your employees. If you have any questions, please feel free to reach out to us. We'll do our best to get those answers to you personally, or we could come up with other webinars to tackle those questions that you might raise. Feel free to reach out and we'll definitely get you those answers or feedback. Thank you guys for joining us, and on the next webinar, after implementing train, I'm sure the next challenge is how to communicate this at an employee level. We'll tackle that on the next webinar, and I'm excited to see you again then. And please stay tuned for more topics as we tackle this change together. Thank you, everybody. You guys have a good day. Bye-bye.